Take a closer look at the markets after yesterday's decline of about 1% for the major indices. Joining us now is Ross Mayfield, Baird investment strategist. Good morning, Ross. You're very dovish about things. You think that I don't know, and Pollyanna-ish from what I can tell. So you think the Fed's still too tight? You can't imagine why they're taking their time to get closer to what you think is a neutral rate, and I guess because of that, you say the job market's really slowing and unemployment is rising. Is that fair to say that? So you think they ought to keep cutting?
Yeah, I mean, look, obviously the job market is doing well enough to propel the consumer and send the economy to a nice year. But I think that the Fed needs to realize that the pace of hiring has slowed meaningfully. Unemployment has ticked up. We aren't talking about the Somme rule anymore, but a couple months ago, that was the big thing, and it's supposed to signal a recession or a slowdown. I just don't know why the Fed isn't trying to get to neutral with a little bit more haste, why they don't project getting to neutral for several more years when inflation is back down between 2 and 3%, by most metrics, and the job market is slowing. It seems to me you'd get to neutral, then assess the outlook going forward and leave, future hikes on the table.
It's closer to 3 than 2. And what other parts of the economy or the markets indicate to you that we're in restrictive territory?
Well, the housing market, manufacturing has certainly, been a bigger weight on the economy than the consumer sector. So basically everything outside of consumer services. Now, that is the economy.
That's the economy. I'm talking about the markets. I'm talking about the stock market, the spreads, the Bitcoin, crypto. Nothing. It seems like there's a lot more, I don't know, speculation than people being worried about the economy. And what's the unemployment rate? The unemployment rate's been rising to what? What would have been a very low level over the last 50 years, or at least 30 years.
Certainly. And I'm not arguing for some, massive easing or some, zero interest rate policy, the return of the 2010s. But I think that getting to neutral, at a 25 basis points a meeting pace until we get there, which is, 3%, 3.25% on the Fed funds rate makes sense. The Fed's trepidation at the most recent meeting was just a bit confusing to me. And then as for, the speculation or the way the market looks, valuations are certainly extended, but we had plenty of speculation in the 90s and the 2000s and when rates were higher than they were now, both the 10-year and the Fed funds. So I don't think it's a prerequisite to, stop speculation in certain sectors or certain asset classes. Liquidity, it seems abundant, but I just think that getting to neutral with pace, or at least the kind of hand-wringing over the current state of things, is a little unnecessary.
The move to cyclicals has not... you think there's more left there, and you think the you think the Mag 7 and MAGA reasserting itself next year?
Yeah, probably the most optimistic story heading into 2025 from this last few weeks when things have really struggled is that Mag 7 has kind of reasserted itself. The AI trade has found its footing a little bit. And, again, it's not the whole economy, but it is in a lot of ways the whole market. If you're an S&P investor or you own a broad market fund, it makes a big difference whether those stocks are working or not. And so I think that they've reasserted themselves as leadership heading into 2025 is important for the broad index investor. We still want to see things like financials and industrials do well. But that Mag 7 trade still matters because it's 30 to 40% of the market on a given day.